We just published our reporting season preview for the gaming sector. We cover 6 stocks in this space, and 5 of them are reporting in August. Some of the key themes we can expect to come out of this reporting season will be the greater frequency of the large lottery jackpots, which will be an important driver for both Jumbo Interactive and TLC, the lottery corporation. The reopening of casino venues and other gaming venues will be important across the piece, as will be the regulatory investigations that we're currently seeing, notably into the Star. The change to gaming tax regimes will be another theme, particularly around the point of consumption tax increases that we've recently seen in the wagering space in both Queensland and New South Wales. And then in more broad terms, the sensitivity to consumer confidence, because gaming has traditionally been pretty resilient. Back in the GFC, spending on both wagering and lotteries actually went up for various reasons that you might want to consider. And at the moment, we don't think that there's going to be anything to be too concerned about in terms of reduction of consumer demand for wagering and betting. So in terms of the stocks that are going to report, the Star is the first one. Now, we downgraded with this report to a hold. Now, we've also cut our EBITDA forecast pretty materially with this, 28% down in the current year, which really reflects poor operating cost efficiency, particularly around labour costs, as they reopen the casino under the cloud of ongoing restrictions to capacity. But the result is coming 9 days before the Bell review into a potential non-compliance with anti-money laundering responsibilities, which of course we think is going to lead to a fair amount of reputational damage and potentially some pretty material financial penalties. So we certainly don't want to be pushing a positive angle ahead of that. You'll remember that the Crown was fined $50 million, $80 million recently. And that may give you a sense for the scale of a potential penalty that the Star could incur. Now, of course, I don't want to second guess what the Bell review is going to say, but I don't think it's going to be good. Moving on to the next two, being Tabcorp and TLC. Sorry, back on that first slide. They're reporting on the same day. This is 3 months after the demerger. And given all the information we've seen in the market recently with these two companies, I don't expect much in the way of a surprise. Tabcorp's earnings will be down year on year, given lockdowns and adverse weather, whereas TLC, because of that greater frequency of the large jackpots, will be up. And then just the last two, Jumbo, which I'll touch on in more detail in a second. Jumbo, we expect to have a pretty good result. In fact, it could be better than we're forecasting, which is why we have it as a positive surprise risk. Good positive earnings growth because of the growth of those jackpots, but also with what they're doing in their SaaS business is really ramping up with some new contracts that they've won. And then on the last day possible will be Bluebet. Now, don't read anything into that. I mean, Bluebet's doing its thing. The Australian business, I think, will be positive, although its investment in the US will, I expect, push group EBITDA into a small loss of $1 million. But we're forecasting a smaller loss in consensus, and we think that could be a positive surprise. So on to the next slide. This just shows this all graphically. You can see that the lottery exposed businesses we expect to show positive earnings growth, slide on the left there, whereas the Star and Tabcorp expected to be in negative territory. In terms of how we compare to consensus, you could throw a blanket over us. We're all within 2% of each other, really, so no particular surprises there. And you can see the share price performance on the right-hand side. The laggards are the Star and Aristocrat, whereas the one that's outperformed, I think possibly outperformed too much, is Tabcorp. On to the next slide, and just to round it off with our two key picks in the sector. The first one is Jumbo. Now, Jumbo has some really excellent strategic growth opportunities, both here in Australia, but also overseas in the UK and North America. A few real key drivers here. The lottery business is going online. You can see from the chart in the middle here that digital penetration of lottery sales is going up and up and up. We're forecasting it's going to be up at 60% by 2030. But to be honest with you, it could be 100%. So that is a really good underlying growth dynamic with people buying these tickets online rather than through newsagents. And I think that's going to be a key driver for the lottery retailing business for Jumbo. But complementing that, it's not just about the large lotteries, it's also about their SaaS model. So what they're doing here is they're providing what they describe as powered by Jumbo, the technology to allow you to run your own lottery. And this is really important for charities in particular. So if you're concerned about ESG as it relates to the gaming sector, this could be one to look at, because what they're doing is they're helping charities to make money by running their own lotteries. This is a really uncompetitive part of the market, and Jumbo is really taking full advantage of that to drive growth pretty strongly. And then just finally, M&A. There has been 3 acquisitions that Jumbo has made over the past 3 years overseas. This is going to continue. They've got a strong balance sheet, and I think you'll see them push into the US as well. So worth watching this stock. I think it's going to be a really strong performer over the next 12 months. And then just finally, last slide, please, Jack. So Aristocrat doesn't report in August because it's got a September year end, so it won't report until November, but it still remains our number 1 key pick in this gaming sector. Now, why is that? It's got a platform to continue to drive market share gains across the board, as it is at the moment in its core gaming business, but also in its digital games business. The revenue growth performance has been extraordinary, 18% CAGR over the past 5 years. Every reason to think that can continue as they continue to invest in design and development. The quality of the earnings, as I say on the second point here, is pretty high. The cash conversion is good. 80% of their income is recurring. So you do have good comfort as an investor that they are going to deliver what they say they're going to deliver. And then just finally, one of the reasons the stock has underperformed, of course, is the failure to get the acquisition of Playtech over the line. But this online real money gaming opportunity is still very much there. Aristocrat is much better placed than many to get into this space, given that it already offers digital casino games. It's not too much of a stretch to turn that into real money gaming. They'll do it through M&A, but they've got $3 billion on the balance sheet, even after the buyback. And as a result of that, they're going to deploy those funds to create, I think, a really compelling third avenue for growth. And as you can see from the chart in the middle, acquisitions have been really important in driving their earnings up. Playtech, the red bar on the far right there, that's what it would have done to EBITDA, but that's what they've got the capacity to deliver through current acquisition firepower and the war chest. So watch Aristocrat. They're not going to sit in their hands. They will grow. They will grow organically and inorganically. At the current share price, it's just, for me, it's a bit of a no-brainer.